Hello, welcome to the Weekend Investing Daily Bytes. This is May 18th. We had a wonderful response from the Weekend Investing Byte yesterday, which was on gold and how to invest in gold. So we are taking another series on that and talking about sovereign gold bonds today. First, let's take a view at the market. So markets, as we pointed out yesterday, seem to have caught on a new leg upwards, and all the sub-segments of the market were nicely up. The market opened gap up, and it stayed there. The small caps were running the fastest, and everything is green on the slide, whether it is weekly, monthly, or the financial year. So this is looking good right now. In terms of sectors, there was sector rotation. Yesterday, we saw that PSU banks were running very hard, so they seem to have taken some breather today, and instead, autos and energy stocks took the lead. Again, the metals, while they are gradually going forward now, but the major gains have already seemed to be happening, and the move seem to be tempering as of now, but still they are going upwards in that space. In terms of weekend investing small cases, MIMT all cap was the front runner today at 2.7%. And NF10, which has been a great surprising addition to the gains this year, has done 2.4%, and ATH did 1.67%. On the weekly basis, MIMT all cap in the last week has done the best amongst all the strategies. And on the financial year basis, we now have three strategies which are above the 20% mark, one reaching even 28.6% mark. So all good on this front. As I said, we are having a gold masterclass 2 today based on the responses that we got yesterday. We'll take a deeper look at why you should be buying sovereign gold bonds. What are the interest and tenure on gold bonds? What is the taxation on these bonds, and how to buy these bonds in primary and secondary market, buy and sell. So the first question, why, is basically, as we also mentioned yesterday, these are a beautiful product that the RBI has come out with. So it is offered by the RBI as a substitute to try and substitute for physical gold. Physical gold demand, being 800-900 tons a year, causes a lot of forex to bleed out of the country, and the government wants to reduce that outflow. So by offering these bonds, they are able to do that. The word sovereign means it is backed by the government, and so the bonds are guaranteed by the government of India. So as long as government of India is solvent, there is no risk on these bonds. There is a limit how much you can buy these bonds. You can invest 1 gram up to 4 kgs in a financial year per head. So in a family, if you are a large investor, you can easily go much beyond 4 kgs on different family names. But this is a limit for one person, and there are different rules for trusts and other entities. But for individuals, you can go up to 4 kgs. Very quickly, what has been the difference in terms of costs for holding, having gold exposure through ETFs? So ETFs typically have holding or expense ratios which are nearer to about 1%, or even including the tracking charges. Tracking is a major issue that I have seen recently, also in the last few months, where when the price of gold is doing well, and you want to sell your position, I mean, you get a percentage less than where it should have been. And when the price of gold is down, you are buying at more than the NAV or the fair price. So you get hit both ways when you try to transact in some of these instruments. So gold mutual funds also have an expense ratio, and some of them also probably have a exit load at 1%. SGB, the sovereign gold bonds, without having any of these costs, returns plus 2.5% on top of this, which is the interest calculated on the issue price, and that 2.5% taxable interest is given to you during the year twice. So it totals 2.5% for the year, and it's given in two parts every 6 months. The last, when it matures on the last day, then the last interest is paid alongside the principal. The tenure of sovereign gold bonds is 8 years. So the government issues a notification in terms of how many gold bond series will be there in the next 6 months, for instance. There's typically one every month or so, and those series are there for plus 8 years from the date of issuance. There is a provision for a premature redemption at the end of 5 years. So a lot of people are in this view that once you buy sovereign gold bonds, you will be stuck. So that is not the case. These bonds are traded on the exchange. So in case you wish to get out, you will be able to get out. But if you wish to hold, you can hold for 8 years, and there are benefits for that. I'll tell you in the next slide. Premature redemption is basically at the end of 5th year, 6th year, 7th year. Also, you can redeem the bonds and get your money. You can always buy and sell in the secondary markets also at the market price. So the redemption happens. There is a association called IBJA, the Bullion Jewelers Association. They take out some end of the day rates for gold 999 purity, and the last 3 days of average rates from minus 3 days from your redemption date, 3 days average will be taken, and at that rate you will be redeemed the money back. So if you've taken, let's say, 1 kg at 47 lakhs, that price calculation will happen on those last 3 days based on the IBJA rates, and that money will come back to you. In terms of taxation, the most beautiful part of this product is that there is no capital gains on it if you hold it to redemption. So if you hold it for 8 years and redeem it at the end of the maturity, there is no capital gains from when you acquired this. The acquisition of these could have been in primary or in secondary, but there is no capital gain. So just imagine on a very long-term basis, if gold CAGR is 11% plus, and that is tax-free. So pre-tax, it is almost, depending upon your slab, etc., it is almost equivalent to maybe 14 to 15% pre-tax returns. And on top of that, you're getting 2.5% taxable interest also. So it beats me why people don't want to go for this product, and this is not yet so popular. But these are the sort of underlying advantages. So if you are holding it for small periods and selling it off in less than 36 months, it will be taxed as your normal income slab. If you're holding it for more than 3 years, but you sell it in the market, it will be taxed as long-term capital gain 20% with indexation benefit. And the yearly 2.5% interest will be credited semi-annually, and will be taxed as income from other sources at your regular tax slabs. Now, how to buy gold bonds from primary market? So right now there is an issuance which is open, which is open till 21st of May. So this is a screenshot from the broker's terminal. So you have to find in Zerodha, for instance, you can go to the coin segment, which is their mutual fund, ETF, etc. buying segment, and there you will find this, and where you can just enter the quantity that you want to buy and place the order. This order will get activated on 21st May. So you need to make sure that your broker account is funded for this amount that you will see here once you enter the quantity on that day. Otherwise, this order will get rejected. So if you put in 1,000 quantity here, you need to make sure that you have 47.27 lakhs in your account on this day. Otherwise, this order gets rejected. And once this order goes through, within about 10 to 12 days, you will receive these SGBs in your demat account from the issuer. So this is where within coin is where you need to go. So we go below in coin and go to the ETF and SGB slab, and you will reach that site. In the secondary market, just like you search for a stock in the stock list, you can search for SGB, and you will get all these series, different series which are ending. For instance, this SGB September 28 is basically a series which probably started in September 2020 and will end in September 2028. And it would have the details about the issuance price, and so 2.5% will be the interest will be based on the issuance price. So this is how you can select these scripts in your watch list and buy or sell these just like any other stock. So yesterday, after we did the daily Byte on gold, we got a lot of questions. So I thought we will go through these questions here, and so that for the benefit of everybody, these questions will get answered hopefully. So Harvey said that Nippon gold ETFs, are they safe in terms of liquidity? Is there a counterparty risk and relatively not safe? So it will be wrong for me to say either way whether there is or there is not. But the most of the gold ETFs, they do claim that they are fully backed by the collateral, and they say that you can come to our office and check the audit report on that collateral. I am not sure why they don't put it up for public review in terms of that certificate or that audit report being available on their website or on the investors' demand. But as per the SEBI regulation, each gold ETF needs to be backed fully by gold, and my perception is that none of the gold ETFs would be not fulfilling that. But in terms of relative safety, yes, I mean sovereign gold bonds, etc., will be much more safer from that perspective. Varun says, for someone who is just starting to add gold exposure, does it make sense to go lump sum or SIP like? Again, it depends on the cycle of where you are in terms of the gold cycle. So I think gold has a long way to run from here. And that is my personal belief, but I could be totally wrong. And I think in inflationary environment that is already here to stay, and gold will probably surprise a lot of people. I am biased for having gold and having a gold exposure. So take an unbiased view and maybe go SIP wise. Or if you wish to go with my view, then a lump sum at this stage would be nice. Thank you for your appreciation of the video. Alok Parikh is saying, one question, I see the SGBs are traded on the exchange. So if I buy any of these SGBs, who will receive the 2.5 So this is just like a stock, like a demat stock. So whoever is holding the demat stock on the day of the dividend record date will get the dividend. So if you're buying it 3 days before the dividend and you are able to get it in your demat account on the dividend record date, you get the dividend. So it is not prorated or divided like that. Akarsh says, what should be the minimum and maximum period one should get invested in the gold? Are SGBs for 8 years and only, and then we have to redeem it? Is it the right things to do for such period, as gold has tremendous returns for getting more? So my sense is that you should have allocation to gold. Don't look at it as a trade. Don't look at it as a transaction that you need to get out of. Allocate it as a part of your portfolio. Whatever percentage you may deem fit. My thumb rule, as I said yesterday, is half your age as net worth, but that may or may not be acceptable to you. But I see it as an allocation, and I'm not looking at it as a trade that I need to get in or get out. If my entire portfolio is growing, I'll allocate more to it. If gold is not growing, if gold is growing more, I'll allocate out of it and keep it at my allocation. So that's the way I look at it. Foreign Yatra says, for SGB, if bought from secondary market, capital gains tax benefit may not be available. Government is yet to clarify. So my sense is that anybody who holds it at maturity should get the capital gains benefit. There is no clarification as such that I could find on this, but this is what my sense is. If there is a clarification against this, we'll come to know, because the first 8 years series has not really come around, but the first 5 year redemption period has come around. So I have even checked with the SGB team at RBI, and I have not gotten any clear answers for this. So my own sense is that whoever holds it on maturity gets the benefit. PG is saying, any advantage to buy SGB from secondary market? If I buy SGB October 25, will I get matured in October 25 for all benefits? And I will not be bound to hold it for 8 years. Yes, so if you don't want to buy it for a longer duration, you buy it from secondary market. October 25 is less than 4 years, or maybe little more than 4 years from now, and you will get the capital gains benefit according to me. And but one thing to note will be at what price it would be the right price, because the 2.5% interest that will be calculated will be for the price at which October 25 was issued, which was probably near 30,000 rupees per 10 grams. So you need to do a reverse calculation of the future earnings and discount it to the current day to figure out the discounting of it. But somewhere near the current price or discount to the current price would be the right price for this. So I want to thank you all for the wonderful comments and for appreciating the Daily Byte series. I hope you gained some additional insights into the sovereign gold bonds today. The issue is open till 21st May. Government is not paying me to market this, but I think it's a beautiful product that you should have in your portfolio. So please subscribe to the channel and leave your comments below. It gives us a great motivation to read your comments and to find out what more we can do in terms of the Daily Byte subjects. So thank you and goodbye.